Well, welcome to the August 2021 Investment Committee update from FMD Financial. I'd like to welcome, as usual, Richard Dahl, Chair of the Investment Committee, and Mike Reynolds, Director at FMD. Thank you both very much for joining me today.
Thanks, Louis.
Well, we start today with global markets at record peaks. I think a stronger share market has never been seen in Australia, which seems a bit strange in the circumstances of a COVID crisis and Sydney returning to lockdown. Can I ask you, Mike, first of all, why, if half the world is still struggling with COVID or more, and and half of Australia, why is the market so high?
What's the conundrum that all investors sort of are challenged or faced with at the moment? I think the reality is that governments have done a remarkably good job at trying to stabilise the ship, considering everything that's been going on around the world regarding the pandemic. So record low interest rates, government monetary stimulus, lower cost of debt servicing for households have basically meant that certain sectors of the market or companies in the market have actually done reasonably well. And yet then there's been a certain sector of the market like travel and hospitality that have been knocked around pretty difficultly, or in a difficult format for them. So company profitability has been really buoyant, and the winners, which we'll perhaps talk about later on, have done extremely well. And share markets and fixed interest markets are effectively a measure of each other in some way. So when the cost of interest rates is extremely low, then your alternative for investments are probably steered or pushed towards the equity market, and share prices have been bid up accordingly.
So the stimulus has worked?
I think absolutely it has, and from a share market point of view, definitely. And if you look at unemployment rates around the world, businesses have been able to adapt, move online in a lot of ways, continue to work from home. There's been a massive acceleration of change in terms of the ability for businesses to continue to survive and prosper, and governments have facilitated that process by giving us or buying us time so as that they can deal with the medical crisis that we're all faced with.
Thanks, Mike. And Richard, corporate profits even though markets are high and the stimulus is there, corporate profits are also genuinely high in many areas, aren't they?
Yeah, look, if you think about what we did in the AMS strategy last year, we said we introduced more technology into the portfolios, both Australia and globally. And technology's been a real winner through this, but there's been many other winners because we think about what's happened to our behaviours through economic lockdown, Lee. We can't travel. Even travelling interstate, like getting to Melbourne is a difficulty, getting everywhere. So airlines aren't one of those winners, but there are others where it comes to home improvements, automobiles, the resource sector, global growth in has been strong. Equities and iron ore prices have been strong. So there's been a number of different sectors which have been strong, and that's been real drivers for investment returns, bringing to all-time highs.
And who are the losers, Mike? We know Qantas are really struggling, and
so they've announced 2,500 people stood down for the next 8 weeks. On the back of Sydney being locked down. Hospitality, hotels, travel have really been the main losers in that space. We've also seen in more recent times a number of merger and acquisition scenarios. And interestingly, we just talk about the travel sector being disadvantaged. I mean, we've seen a takeover bid for Sydney airports, which is from a consortium of Canadian teachers' pension funds and some of our industry funds management groups here that have bid above $8 for Sydney airports, even though operationally they're still trading at 80% below their passenger numbers pre-COVID. So opportunities or opportunistic takeovers for a major infrastructure asset reflects the value in those businesses that still are challenged by COVID. And as Richard sort of talked about, some of the home improvements materials, groups like Temple and Webster, where people shop at home, have decided to upgrade their can't travel overseas and can't go on the holiday, so they'll buy a new lounge suite. So those sorts of things, and that's not just that is not just a reflection of what's happened here. It's been consistent in overseas, in Europe and America for similar behaviour.
Yeah, and certainly pre the Sydney lockdowns, sentiment in Australia for business is very high.
Yeah, consumer sentiment and business confidence had shown a real uptick in the last 6 months. So particularly as we started to get on top of the lockdown. I mean, Victoria had gone through a very difficult period with more than 180 days of stuck at home for non-essential services, and now unfortunately for Sydney, New South Wales have sort of started to experience what we in Victoria experienced last year.
So, Richard, businesses are confident, households are confident. They were never wealthier in some ways.
Yes, like adding to what you're saying there, what Mike's saying is that asset prices, when we start feeling wealthy, we look at the lift in property prices, share prices, infrastructure prices. It's making people, in an environment where we've got very low interest rates and cost of capital, people are feeling quite wealthy and confident. So this has built upon itself to help drive equity prices.
I think there also, Lee, is that because governments have artificially adjusted interest rates low to ensure or to give businesses the best opportunity that were challenged to get through this scenario, the flow-on effect of that is the cost of the average mortgage or servicing the average mortgage has reduced. So people naturally feel more confident. House prices have recovered, and that confidence to be able to spend, feeling that your debt levels are starting to get under control, has flown through to that consumption side of home improvements and all those sorts of things.
So we're sitting at a point where the markets are at all-time high, business confidence is high, and consumer confidence is high. Everyone's confident, but what are the risks?
Well, the risks to equity markets that Mike was addressing, interest rates before and the low cost of borrowing. Equity markets are sort of inversely correlated with interest rates. Lower interest rates are supportive of equity markets, and the one sort of, if you like, a bogey for both bond markets and also share markets is inflation, and whether wages inflation will creep in. Now, we had a little episode of that back in February when we caught up last quarter. We actually had a very volatile period in the Australian bond market, and bond prices fell heavily, and share market prices dipped as well. But since then, it's looked like the market's come back and said interest rates and inflation are not likely to rise in the near term. So that's been supportive of equity prices. So that's the one thing. And now bond prices, where they've come to from back in February, so bond markets have rallied a lot. And that's been supportive in the AMS strategies where we've held our position, Lee, with bond markets. A lot of people were calling back in February, inflation's coming, that's going to be the end of it all. That wasn't to be. And now people are on the other side talking about interest rates remaining lower for longer.
We have seen spikes in areas which would typically point to inflation. We've seen used car prices go higher in Australia and in America. And as one example, how would you respond to that?
Well, the used car prices, there are a couple of aspects around that, but I mean, asset prices per se have risen. Used car prices, there's also a thing around the semiconductor shortage in the new car production. So hence it's easier for people to go and buy used cars. So demand has gone up for used cars. So we've got that spike there. So but there are other asset prices, and you're right, Lee, you say, is that going to feed into inflation? But what's not happening is we're not seeing any inflation coming into wages, Australia or globally. And as long as that happens, there's a number of things behind that, then the inflation expectations will remain low and modest, and the interest rates will be able to remain supportive of asset prices.
So, Mike, your view is that despite the fact that interest rates are artificially depressed at the moment, there won't be enough inflation to justify or cause the central banks to respond and raise those in the medium term?
Yeah, I mean, governments are now by far the most indebted part of the pie. And so every time there's a lockdown, they keep on having to print more money to keep the stimulus, to give you basically to buy time for the whole rollout of the vaccination to be fulfilled, so as we can all get on with our lives. I mean, I think medically it is likely that we're all going to be exposed to the virus at some point, and that is that reality just requires is that as long as people are vaccinated, we don't end up with mortalities and people getting severely ill. So the issue around inflation and interest rates is that while we have this ongoing uncertainty around how long vaccinations take to roll out, whether we have spikes in new outbreaks, new mutations, so we've got the Delta variant, it'll be whatever the next variant will be, is that that continued uncertainty means that governments are going to continue to supply stimulus until we get to a point where the uncertainty is removed and we can get on with what our lives were previously. And so while that occurs and while that uncertainty remains, governments will keep interest rates low. And even if inflation starts to build a little bit, then I still think that the upside in interest rates is so contained because governments are so indebted. And so therefore, share markets may become or have experienced a volatility again, but I think the story continues to remain. And that's why, from an investment committee perspective, we remain overweight growth assets, underweight defensive assets, because you're not getting paid to be invested in defensive fixed interest investments. And as like we do every month at a committee meeting, we'll retest our views on all those sorts of things and adjust our positioning as we see fit, as long as the data supports that information.
Great. So from your view, the two things acting as a brake, if you like, on interest rate hikes are that inflation isn't as likely to grow as some people may predict, and also the central banks worried about their own country's debt levels and not wanting to ramp those rates up and cause themselves problems.
Yeah, I think that's the reality that every central bank around the world faces.
Yeah. If I can pick up your point on COVID, where we've got evidence now that the vaccination rate in countries where vaccinations have been higher, the Delta strain is coming through still, but the evidence appears to be that people's health is being protected by the vaccination, even though they're still getting the virus. Do you see any other risks, apart from the slow vaccination rate in Australia? Do you see any other risks for us around COVID at this point?
Well, I think there's the unknown is what happens with the virus mutation and the ongoing protection from vaccination in there. That's certainly an unknown, just like it is like with influenza vaccine. So there's that uncertainty. Obviously, there's a resistance by some parts of the population to be vaccinated, and so what impact that will have on opening up economies. But there's no doubt we're seeing the opening up of economies in the UK and the US, and we're not there yet with rates of vaccination. I'm sure we would like to get there and be somewhat more unshackled than what we are. And so I think at the moment, while we think that the vaccination program is certainly proven in the US and the UK to help people's outcomes when they do get COVID, there'll be ongoing information about what happens with COVID through the next year or so. So at the moment in Australia, we're looking for just increase in vaccination rates and getting things under control in New South Wales so that we can unshackle our economy and get more certainty.
Yeah, thanks. Well, let's perhaps look ahead then. So we've looked at what the big risk we see is inflation, and our view broadly at the moment to be tested consistently is that it's not likely to run rampant and interest rates to jump up quickly. So what is the asset class look at, and what's the overall return profile look like for us in the coming 12 months, Richard?
Okay. It's fair to say that this time last year, people were quite pessimistic about looking at their returns, and the media and everyone does focus on 1 year returns, and we saw them being advertised recently about 30 June returns, and not surprise, you take a low point to a high point, the returns look in the teens for most diversified portfolios. But when we should be looking at these over 3 years. And so while we're still positive, we're overweight equities, we're overweight property infrastructure. We think those on a relative basis compared to bonds and cash look attractive. We think we'll better than average returns over the next 1 to 2 years. But we won't be seeing sort of numbers of 15 or 16%, sort of high teens numbers when we break up the various components. So still positively.
Right.
And that's how the portfolios are positioned in AMS.
Thanks, Richard. Mike, one of the things that happens in hotter markets is M&A activity. Where do you see the markets at the moment in relation to M&A and opportunities and challenges for our portfolios?
Well, there's a lot of money looking for homes at the moment. So private equity have raised a lot of capital, and we're seeing that. So just even this week, or the last couple of weeks. So yesterday we've had the largest corporate takeover action in Australia, where Afterpay, which is a business only 6 years young, has been taken over by US fintech company Square for 39 billion Australian dollars. I'm not sure how many zeros that is, but it's a significantly large number. And then, as I mentioned before, Sydney Airports, we've seen Santos bid for Oil Search this week as a takeover play. Tabcorp is potentially being suited by both private equity and some offshore betting organisations. So there's a lot of corporate activity that is looking to extract synergies out of those mergers. Typically M&A activity is somewhat late cycle historically, but as I sort of mentioned before, I think this cycle is going to extend for a longer period of time. M&A will be part of that process, and the reason why I think this cycle will extend longer is because governments are looking for statistical data to show that when you are fully vaccinated, and what is the number of people that get reinfected, and how severe, and how long do vaccines last? Do you need another booster? If you've had 2 AstraZenecas, do you need a Pfizer or a Moderna booster at some point in time? So until governments get all that data, the uncertainty about the fluctuating effects of COVID breakout is going to continue. And that's why I think this cycle that we've sort of been in is probably going to extend for another 1 to 2 years.
Great. Well, thank you both for those insights. It sounds like there's still some volatility ahead, but we're not in dire straits at the moment. We think that broadly the sentiment is on our side. Are there any final concluding remarks before we wrap up today?
From me, if you haven't had your vaccinations, go and get them done.
Agree. I think wholeheartedly agree with that, Mike. So please do it. The sooner we all do and get closer to higher rates of vaccination, the less of these lockdowns we've been experiencing recently.
Yeah. All right, gentlemen, thank you both very much for your time today, and I look forward to getting back together with you in November. Thanks.
Thanks, Lee.
Bye.